Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today I wanted to address a big question. Why do some traders choose to buy options versus just buying the stock? I'm going to be going through 5 reasons why a trader might choose to buy an option. Then we also want to give the stock some justice. We're going to talk about 5 reasons why the trader might just stick with buying the stock. So I think this is going to be a really good, interesting discussion. We'll go through this point by point, try to go at a pace that everyone can follow. But before we can get to any of that, though, let me first of all say hello to everyone out there in YouTube in the live audience. I see a lot of familiar names. I see a few that are new here. So hello there, Will and Eva, Life in the Fast Lane, Lori, Jim, Lawrence. Who else is here? Marcus, good to see you. Everybody else. Yeah, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you do happen to be here for the very first time, some of you have already sort of raised your digital hand and said, yep, that's me. Welcome. Great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. That's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. But let's get into today's discussion. As we do, of course, the very first thing that we're going to do is consider the risks. Now, as we go to risks, I want to throw out this heads up to our live stream audience members that I'm joined in the chats by my very good friend, Mike Fairborn. Mike's going to be keeping an eye on any questions that come in the chats. If I can't get to those just during the flow of the presentation, Mike's there to pick up my slack for me. Mike and I have been working together for the better part of 2 decades, so Mike brings a ton of experience of this. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody watching, whether live or on the archive, to follow us on social media. It's the best place to connect with your favorite presenters in between the live streams. And you can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me there at Cameron May CS. And you can also find and follow us on LinkedIn. So for example, my account can be found at, go to linkedin.com/in and then /Cameron May CS, CS for Charles Schwab. But yeah, let's talk about those risks. Please do keep this important information in mind. These disclosures are vital, so remember them. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with all of that important stuff accomplished, let's set the agenda for today's discussion. So what we're doing today is really weighing the pros and the cons of buying an option versus buying the stock that the option represents. So there can be various motivations for doing that. So we're going to be going through 5 reasons why a trader might choose to buy the option, but also 5 reasons why they might choose to just stick with the stock. So we're going to set up an example stock scenario, just using a chart, set up a very basic scenario, and then use that to weigh this discussion. Go through the 5 reasons for buying an option, 5 reasons for buying the stock. Should be a great discussion. Let's go right to the thinkorswim desktop trading software platform. Now, if you're not familiar with this software, it's called thinkorswim. You'll notice this is a simulated trading environment, although thinkorswim also gives you access to the trading of real accounts. But thinkorswim is software that can be downloaded from within your Schwab Online account. You just go to the Trade tab and look for the keyword thinkorswim and then follow the on-screen prompts there. All right, but here we find ourselves on a 1-year chart of Eli Lilly. The trading symbol is LLY here. And let's just say that our trader has noticed something about Eli Lilly. And that is, this stock tends to have, it has this tendency to sort of get up and move. What you'll notice is if we look over just these last couple of weeks, LLY was an $850 stock just a couple of weeks ago. And then it shot up to about $1,100. That's a $150 move. Doesn't look like much. You know, this chart looks just like every other chart out there, but the proportions can be important. So this is a $150 move to the upside, and then we drop back about 50 bucks from about around 1,100 down to 950. And it appears to be on the move again. Now, it can turn around on a dime and keep going down. But let's just say that our trader thinks that there's maybe a chance that what has happened before might just happen again. It wouldn't be the first time, right? This thing has moved 150 points here. It's done it a number of times just in the last 12 months. There have been some big moves here. So let's say that our trader thinks, hey, maybe there's a chance, let's say before the 19th of June, let's say before the 19th of June, could be a chance that this continues going up and finishes this 150 point potential journey. So going from 950, maybe back up to previous highs around, that would take us up to about 1100. I think I said it went from 850 to 1100. It didn't go from 850 to 1100. Some of you are probably silently calling me out on that. It went from 850 to 1000-ish, then pulled back to 950. And now let's say that our trader thinks it might go from here on up sometime before June to around that 1100 mark, which it has visited a number of times in the past. Let's say we think it might go up to that price ceiling. All right, well, if it goes there, there are a couple of ways, actually there are a lot of ways that an informed trader might benefit from that anticipated move. But one way is just to buy the stock. Buy the stock, wait for it to go up. Let's say we buy 100 shares and it goes from $990 up to $1,100 in price. Ooh, that's a $110 increase in price per share times 100 shares. That's a potential for an $11,000 profit. Obviously, that's all very hypothetical. No guarantee that it's headed there. But let's say that we also have this trader who understands options. And they have some reasons why they might choose an option. So here's what we're going to do. Let's go consider an example option trade. Now, do we have, well, I don't even need to ask this question. I know that we have some veteran option traders in the audience. So let's go to the trade tab and let's go out here to maybe just the 18th of June. That's a 37-day time frame. And we're going to look at these contracts. So if you're not familiar with options, they are contracts that allow for the potential exchange of shares of stock, right? So we're going to focus just on the call side of the equation for this discussion. I can't teach everything in a 45-minute webcast, but let's look at some calls and let's look at maybe striking a deal with another trader through a contract where we have the right, it looks like our stock is still trading right around 990 bucks. How about if we look at the $990 strike? That looks like those contracts will be trading between $43 and $46 right now per share. So here is our example trade. This is going to be our example option trade. Buy a call option. Okay. And in this case, we're considering buying the 18th of June 990 call. And let's say we split the difference here. It's trading between 43 and 46. Let's say it costs us $44.50 per share, right? Why are we doing this? Let's lay out 5 reasons to maybe buy the option. Number one is the cost. There's a lower cost for doing this versus just buying the stock. Earlier, I proposed buying the stock, and let's do a little bit of mental rounding here. Just forgive me. I just like to use the straightforward math. Let's say we're able to buy some shares of Eli Lilly today for $990. It's been below $990 today. It's been above $990 today. Let's say that it goes back. We're able to snag it for $990. Well, $990 per share in order to purchase 100 shares would be a $99,000 commitment, a $99,000 investment. Well, if instead of doing that, we were to strike a contractual deal with another trader where we buy this call, ignore this one that's blue. Let me come down here. I'm going to click down here just so I can get the highlight on the correct line. Anyway, if we strike a deal where we have a contract at the 990 strike, what does that do for us? Well, when we buy a call, we're spending some money. in this case, theoretically, I say theoretically because we haven't actually done it yet, so we don't know how much, if we do it, it's going to cost us. But let's say it's $44.50 per share. What this contract does for us is for the next 37 days, or through the 18th of June, we would then have the contractual right to buy 100 shares of stock for $990. So to lock in a purchase price on stock shares, we can do it in two ways. We can either just buy the stock, that locks in the purchase price, or the trader might enter into a contract that gives them the contractual right to buy the stock at a fixed price. And that's what this does, $990. Now, purchasing the shares was a $99,000 upfront investment. How much is this actually costing us? Well, it's $44.50 per share. We're going to set commissions aside. There'd be an extra 65 cents, not per share, just 65 cents total involved if we're talking about commissions. But just looking at the cost of the option, $44.50 per share for 100 shares is $4,450. So that is about, well, that's just about spot on 5% of the cost of actually buying the stock. Now, it's not always 5%. That's just the deal on this option, on this stock at this moment. But you can notice that is not just a little bit lower cost up front. It is dramatically less cost. So for some, they see that as a reason to potentially buy an option. Now, just be aware as we dive into these reasons, I'm never here to promote a specific strategy. I do like to talk through as an educator the pros and the cons of different potential strategic approaches to engaging with the marketplace, but it's always up to the individual investor or trader to decide what they intend to do with their money. All right, but reason number two, obviously, big lower cost. We went from $99,000 to buy the stock at $990. Now we have the contractual right to buy the stock at any time for the next 37 days, and it only costs us $4,450. All right, what's next? Well, because of that lower cost, as a function of that lower cost, there is higher leverage, or maybe what we'll say is greater leverage with doing this. For some traders, what they like is to have an idea and then try to benefit from that idea to just about the fullest or the greatest extent possible. And that is potentially largely accomplished through the purchasing of an option. Let's explore that, all right? So if we spend that $4,450 right now, $44.50 per share, and our stock goes up just $1. So we're talking about a $1 move on a $990 stock. So we call it a $1,000 stock for easy math. That's 1/10 of 1% of a move in the stock. Is that right? That doesn't feel right, but it is right. If we had a $100 stock and it went up $1, that's a 1% move. This is basically a $1,000 stock. If it goes up a little dollar, that as a shareholder, we might have just had an unrealized gain of 1/10 of 1%. On the other hand, if we were to buy this call option and the stock starts to move up in the direction that we're expecting, we're not thinking it's going to go up $1. Instead, we might think it go up $110, up to $1,100 from its $990 current price. A $1 move up, what kind of a return is that for this investment? Well, we spent $44.50, and there's actually a number, it's known as delta, that can estimate for us how much we might make. It's not just an estimate, it is extremely accurate. All right, but you'll notice it says 54 here. That 54 can tell us a couple of things. Number one, some traders will use that as just a gauge. It'll tell us there's about a 54% chance that our stock is above 990 on the 18th of June. So it is a probability number, but also it tells us the degree of leverage of a contract. In other words, it tells us if the stock goes up, it makes an assumption. Notice that delta starts with D, so does dollar. It assumes the stock goes up $1. And it's an if-then proposition. If the stock goes up $1, then this option will be worth 54 cents more. And it will be. Now, there are some other things that can affect the the value of the option. But if we assume those other variables hold constant, time and volatility, and the stock just goes up $1, that option increases 54 cents in value. Now, does that sound like a lot? 54 cents. Pfft. If I'd bought the stock, I would have made $1. Here I bought the option. I only made 54 cents, but a 54-cent return, let's get out our calculator, 54-cent unrealized gain on a 44.50 investment is actually over 1%. That's 1.2%. 10 times the return on a $1 move than what? No, it's way more than that, isn't it? Because it was a tenth of 1%. It's about 12 times. 12 times. That's rough math. Anyway, yeah, let's just look at that as, in this case, about 10 times the percentage return on that $1 move on the stock. So for a trader who's really trying to optimize this great insight into the chart that they think they have, they can leverage that into, right? But that's option, or that's reason number 2 that some traders choose to buy options. They come at a lower cost and they offer greater leverage, and some options can offer just a ton of leverage. All right, so let's look at reason number 3, and that is options. When we're buying options, they carry a defined risk, a maximum theoretical amount that can be lost. If we spend $44.50 per share, how much can be lost on this trade? It's actually $44.50. If we were to buy the stock for $990, how much could we lose on Eli Lilly? Well, if it goes from $990 down to $900, we just lost $90 per share in unrealized loss. And if we sell, we've now realized that loss, bigger loss. If it goes down to $800, now we're down $190. If it goes down to $700, we're down to $290. We can lose all the way down to zero. As unlikely as that is, it could still potentially happen during the time frame of our ownership of those shares. It happens to some people on some stocks. And so what some traders are attracted to is that when we buy an option, theoretically, unless we tinker around with things or we forget about our option, we let it get to expiration and we are exercised, we have a cap on how much we can lose. And that is, we could lose $44.50. So that defined risk can be attractive to some traders, and it becomes their third reason to buy an option over buying the stock, risking $44 versus risking $990. All right, so what's reason number 5? Options are extremely flexible. So I'm going to call this strategic flexibility. Help me out here. Just stick with buying options. You traders that are familiar with options. If a trader thinks that a stock is going to go up in price, is there an option trade they can do to potentially benefit from that move? Of course, we've just demonstrated one. That's only one of a whole range of strategies that can be applied to benefit from upward moving stocks. Lots of strategic flexibility there. What if the stock is going down? Instead of buying a call, we might, for example, buy a put. There's a direct strategic flexibility to pursue bearish or downward moves on stocks. Well, what if we don't know which way the stock is going to go? We just think something big's about to happen. We could actually do something like buying a straddle or a strangle or something like that. That just means I don't know whether the stock's going to go up or go down. So I don't know whether to buy a call or buy a put. So I have this brilliant idea. I'm just going to buy one of each and then just let them go, see which one wins. And if we get a big move up, the call can make a lot of money while the put might lose its value. If we get a big move down, the put might make a lot of money while the call loses its value. But if we get a big enough move in either direction, we actually don't even need to pick the direction. So those are just examples. There are certainly risks associated with every option strategy, but there is strategic flexibility with options. Today, we're just talking about buying options. I didn't even introduce the potential for selling options. But I just wanted to simplify this discussion as much as possible. I'm tempted to try to cover everything all at once in 45 minutes. I think it's just too much. But there we go. 4 reasons so far to buy an option versus buying the stock. What's the fifth reason? Sometimes we already own the stock and we actually want to reduce the risk exposure of that position. And the purchasing of options is sometimes done to do that through a mechanism known as hedging. How many of you are familiar with hedging? If you're not, I have a resource for you. So hedging is literally just using one investment asset to reduce the overall portfolio exposure that was introduced by another investment asset. So spoken another way, maybe we own some stock and we buy an option. Our stock is bullish, so we need the stock price to go up. If it starts going down, there's risk. So maybe at the same time we own those shares, we buy an option that actually benefits if the stock goes down in price. So that can reduce that downside risk exposure. One of those strategies is through what's called a protective put. Now, I'm not going to go deeply into what that is, but we have in the past. So let me make everybody aware. There was Jim, you said you were new here. I want to say welcome to everybody who's new here. We got 182 people watching. I know there are some new people out there. Make sure if you are new that you've done this, go down and click on the subscribe button. It only takes a second. It doesn't cost anything to do that, but that subscribes you to our YouTube channel known as Trader Talks Schwab Coaching Webcasts. And that channel is where you can join our live streams, but you can also find playlists of previous webcasts. So I have a couple of things I want to show you. First of all, I've actually put together a webcast series, a video series, for those that are brand new to options trading. So we start from scratch, from just the starting gate. So I'm going to go to the playlists here. And if we go to this webcast series called Getting Started with Options, you actually scroll down. We have a lot of webcast series. My webcast series archives are actually down near the bottom. It's right there, Getting Started with Options. Second line up from the bottom, although sometimes the position shifts a little bit. I'm going to click on View Full Playlists. Tawana, thank you. Thanks for the subscription. But here's what I want you to do when you get to this. These are the playlists. Like this was last week's discussion. It was held by Barb while I was out. And then you can see my previous discussions. Scroll down. It's going to take you a little bit. Just scroll down. I know your eyes are spinning a little bit, but you're looking for the word lesson. It'll sort of jump out to you as you start to see it. Lesson 10 of 10, lesson 9 of 10. This is the series that I put together to take somebody from knowing nothing about options to actually going all the way through and knowing all sorts of different option strategies and how to place the orders for them, getting in and getting out. So there's lesson 1 of 10, trading options, building block number 1, long calls. So we go into call options and then put options and then shorting, which is selling them instead of buying them, and so on. Okay, so there are examples for each of these strategies you go to. Anyway, so that's one thing I wanted to show you. But another thing is if you go to the channel, you can just do a keyword search like I just talked about hedging. Let's do a search. Hedging. Look at this. Hedging stock trades by buying put options, a beginner's guide. Or hedging with protected puts. There's a webcast that Rachel did recently. I also did a series of videos called The 3 Reasons Traders Trade Options. And in episode 3, we talked about hedging. So you can just go learn more about these different strategies. But this is a 5th reason why a trader might choose to buy the option rather than the stock. And that's because maybe they already own the stock, and instead of trying to increase reward potential, they're just seeking to reduce risk potential. All right, so those are 5 reasons. It's not an exhaustive list, but I'd ask you to do, if you're watching on the archive, or even if you're here in the live audience, leave a comment and say, what are some other reasons you're aware of that someone might choose to buy an option versus buying the stock? But we got to make the case for the other direction. It's not fair for me to just be one-sided in these educational webcasts and only make the case for the one approach. So there are certainly drawbacks, potential drawbacks to buying an option. So what about just choosing to buy a stock? Sometimes trader will look at a chart and they'll say, I have the choice to buy an option. I'm not going to. I'm going to buy the stock instead. So reason number one, it's simpler. Is that fair to say? You might say, oh, well, Cameron, investing in stocks can actually be really complicated. Maybe we have to go study the company's fundamentals. We have to understand what's going on with the economy. We have to know what's happening with its sector competitors. Well, all of those can also influence the performance of any option that we choose to buy. So it might be just an option is compounding the complexity of what was already a fairly involved investment. And even without doing all that analysis, for some traders, they might just look at a chart. Notice the entire case for what I was just discussing here was that we just thought the stock might go from $9.90 to $1,100. It can be a simpler process. Simple doesn't mean that rewards are guaranteed. Nope, it doesn't. But is it fair to say that saves us several additional layers of complexity to not buy an option? I think that's fair to say. Next up, this is going to sound like the opposite of a benefit, but this can actually be very attractive to some traders. Less leverage. Why would we want less leverage? Well, leverage can work both ways. Let's just talk back through that delta example. Let's go back here to our trade tab, that 990. Looks like our delta has moved a little bit. You'll notice this does move. It's real-time updating that we're getting here. It was 54 cents, now it's 55. But what this is assuming is, hey, if the stock, there's a big if, put an asterisk, put if in all caps, italicized with an asterisk. If the stock goes up $1, our call buyer, the value of their option will go up about 55 cents. Now, again, there can be some other variables, time decay, volatility changes. Let's assume those hold constant. Just the stock happens to pop up $1 like it has already in the last few minutes. Hey, that's an unrealized gain of 55 cents or about 1% change in the value of that option. But what if it goes down? That's why I said if. The stock can also go down despite our best efforts. If the stock goes down in value, if we own the stock and it goes from $990 to $989, well, we're down 0.1% and it doesn't cost us any sleep. If the stock goes down $1 and we lose 1% on our option, you start to get a little bit hot under the collar, 1% move. What if it went down $10? Well, that would be a 1% move on our stock position. It would be potentially a 10% loss in value, possibly more, on our option. That leverage can work in both ways, and some traders are just not interested in that much leverage. Now, another way that leverage can manifest itself is in the exposure to maximum loss. So let me ask a question. Let's assume we bought the stock for $990, and come the 18th of June, end of trading, the stock's at $989.99. It's down 1 penny. What has that done to the stock investor? Nothing. Basically the same value they've invested. They haven't lost any money, maybe a little bit of time. Big deal, big whoop. On the other hand, what about our option trader? They had the right through the 18th of June to buy the shares for $990. Now they've reached the end of their contract time frame. The stock has just gone down a little bit. It's down at $989.99. It's a penny below their strike price. It's a penny below $990. Congratulations. They now have the right to buy a $989 and change stock for $990. It's not worth it. Plus, there's no time for it to correct course. And they've just lost all the value of their investment. They lost $4,400 because the stock dropped a penny and ran out of time. Leverage can work in both directions. All right? Number 3. there is, it's very similar. It's related to that last reason. There is no time pressure. Let's go back to our chart. Let's say here we are on day one. We have trader A who buys the stock and trader B buys the option. We buy the stock, and the stock, instead of racing up to 1100, starts to do this. It just starts to wander sideways. It's going sideways. What's happening with trader A? They think, oh, well, okay, so maybe it doesn't happen this month. It can happen next month, the month after, doesn't matter. Long as we eventually get up to 1100, we're good. Maybe even along the way, oops, nope, I don't want to ruin that. There's another reason. But yeah, what's trader B doing? Trader B is recognizing we're getting closer and closer to my deadline. I only have the next 37 days, 36, 35, 34, 10, 9, 8. It's like a doomsday countdown clock. The expiration of this contract is approaching. We're not getting to where we're going, where we thought we were going to go, and the value of our investment is losing losing ground rapidly. There is a time pressure, a time decay element to an option contract that is not present when we just own the shares. So for some traders, they prefer, once they've made their decision, they don't want to put a timeline on it. This can help us to avoid timing issues. Maybe I'm just not that good. Maybe I'm good at picking targets, but I don't know exactly the time frame in which it's going to happen. Doesn't matter with the stock trade. All right. Number 4. I almost gave this away. If this stock is going sideways and we own the shares, maybe we're not making any money in capital appreciation in the value of the stock, but what's coming up right around the corner? There's a dividend, $1.73, scheduled to be paid. It goes ex-dividend date on May 15th. So if we are a shareholder, we have the right to collect that dividend. That's $173. If we are a contract holder, we bought the call, we don't have a right. We have the right to buy the shares, but we don't own the shares yet. Only shareholders get that dividend. Oh, actually, also, only shareholders have the right to participate in voting for the potential direction of the company to whatever extent. Obviously, let's be realistic there. We can have an impact, but we do at least have voting rights. Now, one thing about the dividend is that not only do we not collect it as a shareholder, when we own a call contract, it can actually decrease the value of our call. What happens when a dividend is paid to the share value of the stock? On the day, well, on the ex-dividend date, the share value of that stock is adjusted down by the amount of the dividend, because that much has just sort of been stricken off the company books as an asset. It got paid out to the shareholders. It's no longer an asset of the company, so they reduce the share value. That's a fair thing to do. And that can negatively impact the call option owner, whereas with the stock investor, they got compensated because they're the ones that got the dividend. All right. So dividends and voting rights are a fourth reason. Reason number 5 might be counterintuitive because it can be very attractive. Lower cost can sound good, but all of us have a certain amount of money to get working. And options can actually be a fairly inefficient way to get the money working because of their very low cost compared to the option, or compared to stock ownership. We might choose to, let's say we had $100,000 that we want to get working, and we're looking at Eli Lilly to contribute that, and we go buy a call contract. Well, that's $4,400 of our $100,000. We still have basically $9,600 to go get invested in working. And if we do it all with options, not only did it take more time and effort to get it working, there is a ton of additional accrued risk across that spectrum of lots of little options contracts working for us. So let me put this in here. Get cash working. the more expensive stock with that lower leverage might be just exactly what an investor or a trader might be looking for to get some cash in there, get some exposure to the upside with, yes, some downside exposure, but not the leverage that comes with options. And with the options trader, they might actually be potentially over trading, because if they get 4,400 bucks invested through this example trade that we've just discussed, well, that's only for the next 37 days. So they would have to do what, roughly 21 similar trades just to get all their cash in. In a bad market, maybe they lose it all in 37 days. But even if they have a good 37 days, they run the course, now they've got to go do it all again. There's a lot more trade management with options. There's much more risk, as we've already discussed, a higher probability of loss. There are plenty of reasons why a trader might choose a stock over an option. But there we go, guys. We've actually talked through this. Should we just go place? How about we just walk through the process of each one of these? Let's talk about how we might place the order to buy an option, place the order to buy a stock. So here's how we buy the option. If we go to the trade tab, we find the time frame that we're interested in. This one was just as an example for today. We find the strike price that we're interested in. And this one we just used 990 as an example. And in order to buy the option, we go to the ask price column here and click on it. And that actually creates a buy order for, by default, 10 contracts. Now, each contract gives the trader the right to purchase 100 shares. So this would be buying 10 contracts at $48 per share for 1,000 shares. So instead of this being a $4,800 trade, that'd be a $48,000 trade as an example. So how about we dial this down? Let's just change that to 1. And it looks like it's now trading between, and this is a good example of the leverage. When we started this discussion, this option was trading between 43 and 46. Now it's more like, if we, let's bring our option chain back up here so we can look at it. It's now between 45 and 48. The numbers have moved up a couple of bucks. Now, a couple of bucks might not sound like a lot, but that's about a 5% move just during the time of this discussion. On the other hand, what has the stock done? It's gone from around 990 to maybe 992. It's gone up a few dollars. This is really starting to show the leverage of that option. All right, but to finish out our trade, let's come back down here. We choose the number of contracts, each representing 100 shares in what we call a standard contract. There are some non-standard contracts out there. But we can set our price as a limit, or we can enter just what we might call a market order. Let's say we're willing to spend, at this point, maybe we're willing to spend $47 per share. This is an example. And we can click confirm and send. That'll bring us to what we call our order confirmation dialog box, which is a fancy way of saying, Cameron, check this box, make sure this is what you want to do. There's a little reminder here that we're using paper money. That makes me feel nice because there's no actual risk here. It's just practice. This is a simulation, not a real trade. But we're buying one Eli Lilly, 18th of June of 2026, $990 call for $47 per share. That's our limit. If we can fill that order, that $47 or less, it'll fill. If we can't, it just won't fill. Eva says, why not a good till cancel on this order? That's a great question, Eva. It was a question I actually was answering in one of the comments on a video. So what is good till canceled? We could let me just do this. Let's just close that for a second. Right here it says TIF. That means the time in force for this trade. How long do we want this order to remain in effect before we just say forget it, cancel it? By default, it's just going to be good for the trading day. So if the market's open, it's good for the rest of the day. If the markets are closed, it's good for tomorrow. Or we could change this to good till canceled, which would make it effective for up to 180 trading days, or until, in this case, the 18th of June. The nice part about that, entering a good till canceled order, is if it doesn't fill right away, but we can get it tomorrow for 47 bucks, maybe we do it then. or a couple of days from now or 3 days from now. The problem here is it's very easy when we enter a good till canceled order to accidentally just forget that we put it in. Go on with our day. It actually will show up in the monitor tab under what's known as the working orders right up here, just as a reminder. But it's possible, if we've forgotten about it, that 3 days, 5 days, 2 weeks from now, this trade that we aren't even interested in anymore, all of a sudden meets our trade order criteria, and it fills, and we buy the contract. And we're thinking, oh crap, I didn't even want it anymore. Should have canceled the order. So yeah, good till canceled orders have potential benefits. They have potential drawbacks, just like just about every decision we make in our trading and our investing. All right. So I could confirm and send this. Looks like it'd be maximum $4,700 plus a 65-cent commission would bring the total cost maximum to $4,765 or $4,700.65. That would be that order. How do we buy the stock? Well, we just go up to the ask price again, but this time for the stock. Jim says, can I put a stop loss on an option? Yes, you can, Jim. Yep. And as a matter of fact, let's do this. If we have a, if we're new to all of this and we're wondering how it's all done, make sure you're subscribed to the channel. Go to the channel and do a keyword search. Let's just do options orders. There we go. How to place options trade orders on Thinkorswim, step by step for beginners. Who's that guy right there? See, this isn't even the same shirt. That's kind of embarrassing. But yeah, that'll just walk you through that, Jim. All right, but back to our trade, how do we buy the stock? Type in our symbol on the trade tab, go to click on the ask price. If you squint really hard, just below notice my cursor goes from nice and big, and as I point to the ask price, it goes to a little tiny. And just below that, there's a little tiny word that says buy. It's actually preparing to buy the stock for you. If I click on that ask price, it creates a buy order for 100 shares. We can just change that order from 100 to whatever number of shares we want. Let's keep it, like we could put in 57. Let's say it's still 100. And let's say that we don't want to spend more than $990 for that. We can just put in a limit. That's my limit. And could be good for the day, could be good till canceled. Let's leave this one good for the day and click confirm and send. So this would be to buy 100 shares of Lilly at $990 or less or not at all. No commission on a stock trade, but there can be on some types of trades like options. That would cost about $99,000 and we'd send that order off. That's it. So Jay Richardson says it's a nice shirt, just saying thank you. Well, obviously it's nice if I wear it this many times. But guys, we've accomplished what I set out to do today. I wanted to talk through 5 reasons why a trader chooses to buy an option instead of the stock. Now, we've also talked about why some traders will just stick with the stock. So everybody, this is what we do on our Tuesdays. We talk through trading options at sort of that beginner level. I try to go at a pace that everybody can follow. I gave you a resource. If you're absolutely brand new, go watch those 10 lessons, those 10 videos that I put together for newbies, and you'll feel a lot better by the end of those 10. All right. Now, I also want to thank Mike for helping out in chat. Mike, very, very much appreciated. Everybody, make sure that you're subscribed to our channel. I've already shown you how to do that, but also make sure that you are following Mike and me on social media. You can find Mike on X. His handle there is at Mike Fairborn CS for Charles Schwab. My handle is at Cameron May CS. And if you reply to one of my posts here, I just reply right back to you. So for example, this morning, I went in and replied to the 10 people who have made comments on this chart that I made a post about just yesterday. Where do you think the S&P is headed next? It's come up to 7,400. Is it going to continue on to 76 or drop back to 72? Now, I also post on LinkedIn. So does Mike. So you can find me there. Just go to go to LinkedIn. Okay, let's just pause. Say it again. LinkedIn.com/in/Cameron May CS. That'll take you right here. LinkedIn.com/in/Cameron May CS. There's my profile. Give me a follow here. Same deal. If you reply to my posts here, I reply right back to you. And these tend to be longer form. Not always, but I don't have the character limit here. In any case, guys, thanks for giving me your time and attention today. I'm going to let you go enjoy the rest of our webcast for the rest of the day. Up next is Liz Ann Live. I also want to thank everybody that's already clicked the thumbs up or the like button on YouTube. Looks like we have 179 people still watching. 55 have already clicked that thumbs up. That's very much appreciated. It's like a pat on the back to your presenter for a job well done. But there's an additional benefit that you don't see, but I do. And that is it gives my video a boost in the YouTube algorithm. Every time somebody likes it, it sends the message to YouTube, hey, people are digging this stuff. Let other people find it. And it helps more people find these discussions of like, why would a trader choose an option over just a stock position? All right, everybody, go have a great day. Enjoy Liz Ann Live. I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.